is what you have. Rahul Arora is with us, CEO at Nirmal Bank Equities. He's with us here in our studios. Rahul, great to have you with us here. Thanks very much. So, I mean, just a quick word on yesterday's session, if you want to weigh in. I mean, you don't see those very often. I mean, I'm not making too much of it, but it was a big deal, right? I mean, the kind of surge that we saw, and especially the data on the option side and what has happened. And I was saying earlier that all that talk of these foreign algo firms yanking markets at will whenever they want, I think that's going to come back. That's going to resurface. And we don't have any evidence. Well, that is what happened yesterday. But sure enough, I think a lot of call writers got killed.
So first off, morning, and thank you for having me on the show, and festive greetings. So I think everything that's happening, let us submit to the divine. Ganpati Bappa Moria. But no, I think on a serious note, Prashant, I think one is obviously the data that you're talking about. The second is, I think, I think ever since Ashish of Axis Mutual Fund wrote that note about promoters selling and, the kind of corroborating it with the SIP inflows. I think if you look at the last 2 months...
about his note on derivatives, because he got one on that one as well. The size of derivative market options, etc. But go on.
True that. But I think if you see the last 2 months, right, I think if you look at promoter selling, it's about 85,000 crores. That's 2x the SIP money that's come in. The question is, where is this money going? And I think, Prashant, you've been in the market long enough to know that there was a time when promoters sold stake, the stocks used to get derated.
Yeah.
Here, there is a queue. And which is very surprising. This is a huge shift. And now, why is that happening is because of the force of liquidity. I think, the kind of money that mutual funds are sitting on, and we've discussed this, I think, by all stretches. I think if you include mutual funds, AIFs, PMSs, family offices, and you look at cash levels, that's about 1.5 to 2 lakh crores of cash at any point in time in the system. That's 1/3 of the size of the mutual fund industry pre-demonetization. I mean, that's the magnitude of what we're talking about in terms of liquidity. So you have a counterbalancing force. I think, the other day I was talking to a slightly senior sell-side person from our industry, a much bigger competitor of ours, and I was like, how is the Asia-Pacific region going? He's like, abhi yaar, Asia ke trips itne kaun mar raha hai jab, SBI is 10 lakh crores, iPro is 8.5 lakh crores, HDFC is 8 lakh crores, and, Kotak and Birla. So the kind of depth that the domestic markets have seen, I think, to just play on the word that you've got, I think the FI money is an option value in the Indian market, so to speak, right now. And I think I heard you spotting some of the real estate stocks. I think that promoter selling money is either finding its way back into the markets or it's going into real estate and high-end real estate. I think if you see the kind of sales that even high-end real estate is doing. Now, do valuations concern us? They do, at a broad level, honestly, Prashant. I think we just got lucky that crude has traded between 65-70 for the last week, 10 days. The external sector in India has been good. There's no question. Our rupee has behaved itself. Crude has behaved itself. And our forex reserves are perfect. There's nothing really wrong with that. We are staring at interest rate cuts. How much, we don't know. But even then, are we justified for a 25,000-26,000 Nifty? I'm not so sure. So, hand on heart, I'll give you a final data point. If you ask all my analysts, hand on heart, to look at the last 3 and 5 years PE averages and project growth over the next 2 years and ascribe a realistic multiple X liquidity, my sense is 80% of my stocks under coverage, and we track about 180 odd, will be sells. That is just, I'm being very honest upfront on national television that this is what it will be. We don't know what to do with this liquidity. And so therefore you are only doing two things. Either you're constantly rolling forward, or then you're saying, forget the conventional PE and EV EBITDA and start doing DCF. Now, once you do that, how can you project cash flows in certain businesses beyond a point? Consumer, I can still understand. So there is a certain level of irrationality, and which is why when I was last on the show, I think a month and a half back, we discussed our downgrade on defense. We couldn't understand it. Some of our competitors still have buys, and good luck to them. But sometimes when you don't understand it, reason has to take over liquidity at some point. So I would advise people to be cautious at this level.
Rahul, just earlier we had Arvind Sanger of Geosphere on the show, and we were having the same issue, the same discussion on liquidity, right? And I was making the point on Bajaj Finance just being a simple case in point that a company goes out to the market to ask for 6,000, 7,000 crores. The market wants to hand it over 3 lakh crores, right? That's the sort of situation we're in, and also the company that Bajaj Finance obviously is. Now, your conversations with some of your foreign clients, I know they're no longer maybe the hottest clients as you say. But what's the sense there? Because till the time this NASDAQ rally continues, I think it's fine because they'll still keep looking at the home market. The day that starts petering off, they will remember markets where they don't have adequate positions built. And India is probably one of those markets. So what's the chatter you're hearing on that side, given that we're getting to the rate cut next week?
No, so I think should be the one clear directive that comes when you speak to any investor anywhere is India is still growing at 6.5–7%. That's still a remarkable growth rate by any stretch. I do understand our aspirational growth rate could be 8 to 9%, but at 6.5–7%, you're gold. You know, and I think add to that, when you're talking about interest rate cuts that you've seen, you are going to see a little bit more of the yen carry trade unwinding a little bit as we go forward. I think if you look at the way the yen's been behaving, it's not, I think that one-day trigger is probably going to repeat itself, maybe not with that level of magnitude, but I think India could potentially be beneficiaries going forward. Now, if you heard that Trump
more
was...
money, which
absolutely.
Brings you back to the question, how are we going to deal with so much money?
You know, like I said, Surabhi, I think what's happening is that industry leaders are getting outsized in terms of valuations. And I'm not even talking large caps. I mean, look at Indian hotels and hospitality, look at Dixon Technologies and EMS, you can look at hospitals. I think what's happening is that the industry leader is becoming disproportionately larger. Look at IT services. I think look at the difference between TCS and the rest of the pack. You have TCS at 30 and you have Wipro at 20. So there's a 33% difference, and this is a large cap name. So, you know, I think that's probably what's going to happen. But I think India could potentially, I don't know whether we will get a disproportionate share, but I think the one thing that the last debate between Harris and Trump taught us, I don't think either of them are too clear on their policies. So if that happens and you will get into a situation where obviously one of the two is going to win, but if they're not very clear on their policies, and I think you have a market like India which is going to go into an interest rate cut cycle with 6.5% growth. But I go back to the point I was making to Prashant, Surabhi, I still don't think, see, India's earnings are going to be driven by top line. Everyone's cut employee costs, everyone's cut subcontractor costs. They've squeezed every bit out of margins from crude. You've built up low-cost inventory. India itself, you know, when the Russia-Ukraine war started, built up inventory at 40, 45. Your growth has to be driven by top line, earnings growth as well. That visibility, you know, as when we talked to a lot of, I was with DMart retail the other day also, he said, itni visibility nahi aa rahi. 13–15% ka growth top line mein aa jayega, which means you're talking about a 14–15% earnings growth. Now, for that, do you want to be paying 23 times to the Indian market, 22–23 times? But then again, you know, as somebody very famous once said, markets can remain irrational far longer than you can remain solvent. So.
Well, you know, you did speak about the point that the leaders will get disproportionately rewarded. What's also happening, the counter to that is that because leaders are getting disproportionately rewarded, now people are looking at the valuation gap between the leader and the significant other. And as a result of which, we've seen a big rally in the others down the quality line as well, not necessarily, you know, as good as the leader. Jewelry sector, that stands out in particular. The last 1 year or so, Titan has underperformed. 2 years ago, Titan was trading at a 3 times premium to say someone like a Kalyan. Now that premium is just about 10%. How do you play this now? Do you stick with the leader because the premium has come down, or do you stick with the other one because on a low base they will grow faster?
So I'll tell you the first thing that comes to mind, Mangalam, when I look at historically how investors react to valuations. They will play this valuation gap, but at some point it will revert to the promoter that they are more comfortable with. That literally just happens. I think the determining factor, the single most determining factor, and which is what we're taught in school as well, that beyond the point the valuation that you will be paid for is for return on capital employed. How you are basically employing your capital, how you are rewarding your shareholders. So that valuation gap can play up to a point. But let's take IT services as an example. Wipro hasn't re-rated to that extent as say a TCS or an Infosys has, right? Persistent has always been at 40–45 times. There have been some ER&D players who were at 20–25 times that have caught up, but the valuation gap still remains at about 30 times, so 30% between them. So I think from here, you look at prudent capital allocation. You know, there have been some companies, and I don't know how actively you guys track this, but a lot of companies that have come up with IPOs, if you look at their objects of the issue, not all of that money has got deployed as well.
Right.
You know, sometimes I wonder, you know, on a lighter note, whether some of that will also find its way into the capital market and they'll make the returns and they'll increase the dividend payout. But, you know, that's on a lighter note. But I think at these valuations, if you're going to get similar growth rates across the sector, let's take, again, just coming back to IT services, I think on a blended basis, if the sector is going to grow 8%, you will have TCS probably growing at 9–10 and the others growing at 5–6. Right, but if you're comfortable with the kind of capital allocation and promoter and dividend payout that TCS has, I think the trade may just come back to something like a Titan over the others, and that may just correct itself.
So given all that you know right now about the markets, the valuations, the liquidity, etc., where do you put your money?
So the first thing is I don't know anything about the market, and I don't think too many of us know, but I think you really have to find value where and it's difficult to. I'll give you some stocks like, let's say, Surabhi alluded to Bajaj. I think, if you look at trailing, Bajaj is coming at 3.3 times. It's not listing cheap, but then you'll obviously have a good, listing gain. But you can look at names like Repco Home Finance. I think that's still coming at 0.7 times price to book. That looks interesting.
Bajaj, by the way, it's going to be a doubler on
For
listing.
sure it will be. For sure.
So then valuations are at
6.6.
where?
So if you look at what Bajaj Finance has traded at,
Which is what someone said, it has to be at least 8
or
times.
Gru Finance, at one point Gru was trading at 7 times price to book, Of course, Gru has never diluted, and that's
But
the
I think
premium.
that era is over, isn't it?
It is, but
5 times, 6 times.
Of course it is, but I think that is probably what will happen, right? Bajaj will list, it'll probably list at, maybe 1.5, 2x the issue price. The question is going to be then what? I think even on a post-diluted basis, I was just speaking to my analyst, I think she was saying it's coming at somewhere around 2.5 or 2.7 times. So even if it doubles, you're talking about 4.5, 5 times straight there. HDFC, any of the stocks that you take, whether it's HDFC Life, price to embedded value is about 2.4 times. If you take the parent, which is the merged entity, that's coming at about 2.3 times. These are all traded at 4.5, 5 times. So, I mean, even if you have a 25-30% growth rate, we've discussed this in the past, Prashant. Bajaj Finance, DMart, Asian Paints, these guys get so priced to perfection that margin for error bilkul nahi hota. Thoda bhi agar, if you're 30% growth rate and you come in at 26%, you'll find the stock down 10% because you're pricing these for perfection. And I think that's the same thing happening with Bajaj. But I think in BFSI, like I was saying, I think Repco is a good trade. We were discussing, we alluded to jewelries. I think Muthoot is still a good trade. And, with all that's happening in housing, I don't know whether it's a name that you guys discuss often. We like Housing Urban Development Company, HUDCO. Coming at about very similar valuations to, say, a Bajaj Finance right now, but 25-30% kind of growth rates. There is some pockets of value still in cement. If you look at the valuation differential, again, going back to the point you were making, Ambuja is still trading at a discount to Ultratech. JK Lakshmi is still trading at a discount to some of the larger peers. Chemicals has been out of flavor for a while. I think, you've had a great run in fluorination with SRF and Naveen. We like oleochemicals as a space. So Galaxy Surfactants could be an interesting name. So it's not like there is no value whatsoever. I think the only place where you're going to absolutely struggle from a valuation perspective is consumer, because those valuations have been very good over the last few months. And I think if you look at QSR, Alcobev, Staples, any discretionary hotels, it's very difficult to justify. So I think if you get like, a little over fixed deposit returns, like 8-10% kind of compounded returns, you should be happy. But I think some pockets of the market still have some amount, but you can't just aggregate, say that, this is where it is. That's the sort of limited point.
It's not an easy market to be in. You have to really dig deep to find little pockets of value wherever they exist. Got that point, Rahul. Thanks very much. Good to have you in the studios this morning. Thank you very much for being with us and sharing the perspective there.
Thank you.
Well, we have to move on and